Lee, I know you have the opposite view. We want to hear it.
Well, you know, first of all, I think you have to take with a grain of salt anything that Harry says. If you read his last, 10 books, he has a lot of wild prognostications. I think the biggest thing that we can derive, and I think that Scott's not necessarily going to disagree with me, we've got a problem with what is called divergence, which means that only about 10 stocks in the S&P are really jacking it up this year, and the rest 400, 450 stocks are mostly down for the year. That's what divergence is. So we've got liquidity hogs, tech market, for instance, FANG stocks, Facebook, Apple, Netflix, Google, they're pushing the indexes up. When did we last see that? We saw that back in the year 2000 when it was Yahoo and Cisco and JDS Uniphase, and so that means you're cruising for a bruising. But not all is lost. You still have places internationally you can buy. Emerging markets, they're left for dead. And when people like Harry didn't want to top ticket and say now is the big problem, I would say it's time to buy, be a contrarian.
So is tech the best way to do that then?
I would say the tech is the place you want to stay away from right now, because the tech sector is a place where they're the liquidity hogs. All these dollars with very little liquidity, it's going into those tech plays because they have these growth stories, but it's unsustainable. And so I think that you have to stay cautious, stay away from that sector, and just look at things that are cheap and undervalued. And if you can find a cheap, undervalued tech stock, go buy it.
All right, Lee Munson, our bear. We gave you more time today. Sorry, Scott Martin, but when it closes up, we got to give the opposite side a bit more time. Glad to have you both.